India's inflation data released today showed inflation eased to 4.89% in April. Dharmakirti Joshi, Chief Economist at Crisil, joins me on the line. Can you tell me, is an ease in inflation a good sign for the economy?
Well, it's a sign of dwindling demand. We have seen very high inflation for the last 6 to 7 years. It has consistently stayed above the central bank's target of 5%. So this month it has come down below the central bank target. But the issue is whether it will remain there or not. We believe that the pressure on inflation is going to ease going ahead for several reasons. One of them is the softening of crude prices. The global crude prices have come down quite a bit over the last few months, and that is keeping the pressure on petrol, naphtha, bitumen, which are all linked to global crude prices. Their inflation is low. The second, I think, more important factor is that because the private consumption demand has slowed down very significantly in India, as a result of that, the core inflation is down to 2.8% this month. What this does is the decline in pricing power of corporates. What it means is that they're not able to pass on the cost increases to the end consumer. So that keeps a lid on demand side pressures on inflation. The third factor, which we are still not sure, but we expect the monsoons to remain normal, which is as predicted by the meteorological department. If they remain normal, then the food inflation will also remain low. And I think going ahead, the pressure points on inflation will essentially come from things like electricity prices, diesel prices, which need to be raised to bring them to par with the global crude prices. They will pressurize inflation somewhat, but I think the demand side downward pressure is too strong, and that will keep the inflation within 5 to 6% during the year.
If inflation does not stay in sustainable levels, do you think more rate cuts are limited for the Reserve Bank of India?
Yeah, I think Reserve Bank of India made it very clear in its monetary policy statement on May 3 that they have very little scope for cutting rates. A reason for that is that the inflation has, despite coming down, it is still above their comfort band. And if you look at consumer price inflation, that is still close to 9.5%. So I believe that the room for aggressive rate cuts is limited unless inflation comes down to below 5% on a sustainable basis. And we all know that this cannot be achieved by the central bank alone. And the government also has to play a role in removing the supply side bottlenecks, etc. So the further rate cuts will happen only if the inflation surprises further on the downside going ahead. Otherwise, we are assuming a maximum of 25 basis point cut in the rest of the year.
Another issue is a shortfall in the current account level, which is above sustainable levels. What measures can be taken by the RBI to get its current account in order?
Well, I think there's not much we can do in the short run. The current account deficit for the last fiscal year, which is 2012-13, is now estimated at close to 5.1%. We believe that current account deficit will come down because gold prices have softened, and gold is a very fast-growing part of India's imports. And also because the crude prices have softened, we import a large part of crude. So these factors will bring the current account deficit to 4.5% of GDP in the next year. Central bank has very little options to rein in the current account deficit. What I think they can, what the government tried to do was they tried to curb some of the imports, but that really doesn't work. So over the medium run, what needs to be done is we need policy measures to increase the export competitiveness, cut the fuel subsidies so that we do not import too much of crude from abroad. I think another way to look at the current account deficit is from the savings investment side. It essentially reflects the difference between savings and investment. So what has happened over the last 2-3 years is that the savings rate in the economy has come down, particularly financial savings. I think to give a boost to financial savings, I think we need instruments like inflation index bonds, etc., which government and RBI are planning to bring out. So I think these are some of the measures they can take in the short run. But I think eventually, unless the export competitiveness rises, I think the current account will remain an issue.
And consumer prices rose 9.39% in April compared with 10.39% in March. Do you expect a further hike in consumer prices?
Well, I think we expect consumer prices to stabilize at lower levels, and I think they could be somewhere between 6 to 7% in the current fiscal year.
And lastly, what areas need to be focused upon to revive economic growth in India?
We are at a 10-year low of 5% GDP growth in 2012-13. We believe that some lift will take place in 2013-14, where GDP will grow at 6%. But I think these are one-off factors. What you need for reviving the growth to higher levels is, first is, I think we need to sort out some of the issues that are plaguing the economy currently. For instance, mining activity is contracting, so there are governance issues there. There are issues of giving out licenses. There are issues of providing enough coal to the power plants. I think all those things need to be sorted out so that resource efficiency of the economy improves. From a slightly longer-term perspective, I think we need to raise the growth potential, where things like speedy clearance of projects, more clarity on land acquisition, environmental and taxation issues, and finally a low inflation and a low interest regime. I think if you have this, then the private investments will revive, and I think then one is talking of lifting the growth potential. Currently, we believe the growth economy has a potential to grow at around 7%, and raising that potential will require a significant kick to investment, and particularly to private investment.
That's all for now, but do check out an interview with my colleague Monica Gibson covering the German ZEW index. Goodbye for now.